looking at silver, the way we've seen it explode, I'm looking for 160 to 180 by the end of 2026. The question is this the top? My answer is categorically not. Not in the least. Now, but I think that silver is such a hot commodity because gold is pricey now. My short-term target is about $115. I believe that we could see it dip a little bit below intraday. I don't see a correction coming in with silver in the same way that it's possible with gold.
The biggest market to move last year was the gold market, far better than the tech markets, right, and so on.
Just give us a target, upside target for gold.
My target at the end of the year, drum roll, is at minimum $6,000 per ounce, at minimum. And when you hear other people coming out calling for $7,000, and these are respectable houses, they're not what we'll call the tinfoil hat analysts that were calling for 10,000 gold 10 years ago. Japanese candlesticks, these are called dojis. It means there's indecision in the market.
$100 for silver, you'd expect strong resistance, and we have resistance for several days. Now that we've got $101 now, you'd expect a lot of selling pressure. Is that what's going on?
The question is this the top? My answer is categorically not. Not in the least. Now, if you look at silver right now and the chart that I've got up, are you able to see that, David?
Yeah.
Okay, we've got March silver futures and then April gold futures. Notice that right now, silver is at 102. So it broke 100 and it continues to go higher and is in fact at the high of the day. This is a Friday, meaning that the markets will be closed for the weekend when you typically get large institutional traders, professional traders squaring positions to lessen their exposure to what could happen over the weekend. We are not seeing that in gold. My personal feeling is 100 is the new floor in silver. It is certainly not resistance. Certainly not. And that's based on what we're seeing. Gold is a little bit different. Gold traded very close to, and this is a daily, very close to 5,000, but has backed off since. Currently,
silver breaking above $100 looks dramatic, but the real signal is who is not selling. As Gary Wagner points out here, the lack of Friday profit taking matters more than the round number itself. Historically, major tops see aggressive institutional de-risking ahead of weekends, yet silver pushed to $102 and held. That suggests positioning strength, not exhaustion. Meanwhile, gold hesitating near $5,000 shows capital rotating selectively rather than exiting metals as a group. This divergence hints at different demand drivers: industrial and retail flows favoring silver, macro hedging favoring gold. For investors, this isn't a breakout to chase blindly, but it does challenge the assumption that $100 was a hard ceiling. What Gary Wagner explains next reframes why silver's floor matters more than its headline price.
Where is it at? Wow, it's at 88. It had gone down to about 70 and people came in and bought the dip. But there, I believe we could see some shallow correction come in. And even if we have a sizable correction, is 5,000 the top? Absolutely not. You want to buy that dip. Because I think that what the world is reacting to, and Dalio said it so well, talking about a transition out of fiat currencies worldwide. The US dollar is not the only one that's fiat. They all are, I believe, with an exception. I'm not sure if Switzerland is, but they're all fiat. And that time has come to an end. I'm amazed that he said that, but that's resonating with me. Gold inevitably will have 5,000 become support, but maybe not yet. We could see a dip here. We could see a dip on Monday. But what amazes me is that it sold off. This is about 10 o'clock in the morning in Honolulu, meaning it's 3 o'clock in the afternoon. Markets only have a little longer to trade. And the fact that it went down to 70, I guess what we could do, well, I'll do that on the next chart, is look at an intraday chart. But as soon as it touched right around 5,000, it moved down quickly. It lost about $30.
Gold slipping $30 near $5,000 isn't panic. It's a stress test of conviction. Gary Wagner ties this directly to Ray Dalio's broader warning about fiat systems. But investors should separate philosophy from price behavior. Gold has rallied over 20% in less than a year, and shallow pullbacks are statistically normal at new highs. The key detail is speed. The dip was bought quickly, signaling demand beneath the surface. For portfolios, this argues against all-in buying at highs and against assuming a top just because price paused. Risk here is timing, not thesis. What Gary Wagner adds next clarifies why corrections don't automatically mean trend failure.
If you look at what it did the other day, and I'll blow this up, this is when gold opened at 48.33 and closed at 49.31. But look at the low. The low came in at 47.74. So it hit these highs that truly were just above 4,900, and then it sold off, I believe, $185 in a very short period of time. I think it was 15 minutes or a half hour. It really bang. And rather than that signaling that the fire's been lit, it's time to correct, other traders who've been waiting, because we've seen really now 4 days of parabolic action, the opportunity to buy the dip. And we're kind of seeing that now with gold back up to about 49.90. They sold it off, and that was very, very short-lived. So the excitement's there. We'll go through my calls for the end of the year as well as my calls short-term, but none of my calls short-term in gold look for a sustained level below 5,000 for a protracted amount of time. And I'm looking for higher prices. The question is, will we see a real correction? Because we've seen gold move up tremendously, and we'll talk about that when we look at a long-term chart, but we haven't had a really deep correction.
A 185-hour intraday drop sounds violent, but context matters more than drama. As Gary Wagner notes, parabolic moves often invite fast mechanical sell-offs driven by algorithms, not changing fundamentals. 4 straight days of vertical gains increase fragility, yet the rebound toward 4,990 shows buyers still control the tape. Media headlines frame this as volatility risk, but they ignore that sustained bull markets routinely digest gains this way. For investors, the danger isn't the pullback, it's mistaking momentum. Pauses for reversals. Position sizing and patience matter more than predicting the exact dip. What Gary Wagner says next challenges how people misunderstand real corrections.
We've had 20, 30% in terms of correction. It trades from $0 to $1 and goes down to 70 cents and then pops back up. But corrections to a market technician can be as deep as 61.8% and still be in a bull trend. So a stock goes from $1 to $2, and then it retraces on that dollar move back down to $1.40, and we say that's bullish. To a technician, it's momentum, and if the momentum doesn't change. So short answer, is this the top? No.
Well, let's take gold first. From a technician's perspective, $5,000 gold, what's the next, I would say, Fibonacci retracement to the downside and then extension to the upside?
All right, give me a second here. We'll do an extension. And it depends on where we're going to do the extension from. I'm going to do it from November, but you see, you can even go lower than that. But we'll start with this one, which is really where we saw it change, although it was parabolic here, but one step at a time. We're going to do a Fibonacci retracement from 39.68. Hold on. From 39.68 up to 49.90. All right.
Yeah.
We've got a basic, let me get this a little bit more fine-tuned. That's why I wanted to blow it up.
The word correction scares investors because most don't understand scale. Gary Wagner reminds us that even a 38% or 50% retracement can exist inside a healthy bull trend, something history confirms across equities and commodities. Fibonacci levels aren't predictions. They're reference points for crowd behavior, especially near round numbers like $5,000. If momentum and liquidity remain intact, price declines become re-entry zones, not exit signals. The real risk is emotional selling triggered by misunderstanding technical pullbacks. Long-term portfolios benefit from knowing where fear is statistically normal. What Gary Wagner outlines next shows how these levels shape upside targets as well.
A shallow correction would take gold from, call it 5,000, let's round up $10, okay? A 23.6, considered the most shallow retracement, takes gold just above 4,700 to 4,730. A deeper correction, but still considered shallow, 4,574. A deep correction takes gold to 4,300. So when you have a market that has run up so quickly in such a short period of time, the correction numbers are still going to be these ratios, the Fibonacci ratio, 4,700, 4,575, 44, 45, 50%, and then 43. That's a huge, I mean, we're saying that we could have a correction to 4,500, roughly $500 from here, and it would be exceedingly bullish if we saw it go to that point and have that V or pivot. And that's a shallow correction, David. Gold could correct, on a technical basis that is, to around 4,300. And as long as it pivots, in other words, it goes there, it forms a base, it consolidates, and these are rough numbers. It can go 10, 20, 30 above or below. And then we get that V and it starts moving back up. It's still in a bullish trend according to technical studies and the way we interpret price movement over time.
A $500 drop in gold sounds catastrophic until you realize it may be the most bullish scenario on the table. As Gary Wagner points out here, Fibonacci retracements aren't forecasts. They're stress tests for trend integrity. Historically, in strong commodity bull markets, 23.6% to 38.2% pullbacks often reset momentum without damaging long-term structure, as seen in gold's 2009 to 2011 run. A move to 4,300 would still leave gold massively above its prior cycle highs, signaling institutional confidence rather than panic. For investors, the risk isn't the correction itself, but misreading it as trend failure and selling into structural strength. What Gary Wagner explains next reframes why recent gains matter more than short-term pullbacks.
Well, what I want to basically do is, in terms of gains, because I took it back to 2023, but I'm starting it really from October, because that was, if you notice that in March 2022, it was still coming down. This was that bottom. So the bottom was really at 1584, okay? Up to current pricing, that is a 209% gain. That is a gain of, oh God, is it really? I mean, these numbers fascinate me. Could it really be? And it is. That's a gain of $3,367 in the time span of 3 years. Incredible. What we have to acknowledge is we saw a very nice but steady move from down here. I'm going to round up to 1,600. Then it hit 2,000 and kind of stabilized there. 2,000 from March of 2023 up to February 2024. And then it had that nice controlled move up to 2,700, came back down to about 2,500. But if you look at the tack, the angle of these rallies. This rally is much steeper of an angle than this rally. This rally actually really begins to accelerate from 2,600 in December 2024 up to 3,400 in April 2025.
A 209% gain feels euphoric, but the path matters more than the percentage. As Gary Wagner highlights here, gold didn't explode out of nowhere. It stair-stepped higher for nearly 2 years before acceleration kicked in. That slow grind from 1,600 to 2,700 built structural demand, not speculative froth. The sharp angle since late 2024 is where risk increases, because steeper trends historically attract momentum traders rather than long-term allocators. For portfolios, this argues for discipline, trimming strength, not abandoning exposure. Big gains don't end trends, but unchecked acceleration often invites volatility. What Gary Wagner says next explains why consolidation phases are more important than price highs.
And this was the last real period of consolidation from last week of April
Yes.
to August. And then things changed, because then we saw an almost parabolic move. And I've converted this to a weekly so that we can fit things easier. We did get a little dip here from a high of 4,400 down to about 4,000. If you look at the lows, 3,900. This is the largest correction that we saw within the last 3 years. And then it just moved higher. Solid green candles. You have one strong red candle, and even though that's a weekly, that's all in one day. I believe that was the last day of December when it lost. Let's pull it up right here. When gold lost $285. The only other time recently that we've seen that was on my birthday, October the 21st.
All right, everybody mark that down in their calendars.
Yeah, okay, yeah, sure. But you can see that after these series of small body candles and Japanese candlesticks, these are called dojis, it means there's indecision in the market. Neither the bullish faction or the bearish faction have absolute control.
The 285 red candle looks scary, but markets don't turn on single days. As Gary Wagner notes, doji candles signal institutional hesitation, not mass exit, something often misreported as distribution by headlines. Historically, major tops require weeks of failed rallies and expanding volume, not isolated air pockets. The fact that the largest 3-year correction held near 3,900 shows buyers defending structure aggressively. Retail investors are often shaken out here, while funds quietly rebuild exposure. This is where narrative diverges from positioning, and patience beats panic. What Gary Wagner points out next reveals how indecision often precedes continuation, not collapse.
It is what the Eastern trader, the Japanese trader, those in Southeast Asia and China use to determine when a pivot is possible from bullish to bearish. And what we got was, we did have this real quick but actual correction, and then it was off to the races. If we look at, and these are dailies, we've gone parabolic for the last 4 days. So incredible moves.
All right, let's move on to silver then. Actually, before we do silver, just give us a target, upside target for gold. What can we expect in
Absolutely.
2026?
I'm going to break this down to short term and by the end of the year.
Yeah.
Short term, I'm looking at between 5,100, more likely 5,200 to 5,250. Short term, I'm talking about before the end of this quarter. I don't want to use time, because every time almost all of us analysts talk about time, we get it wrong. The market could go to a normal pace, and that's what I'm anticipating these numbers on, but it could happen in 2 or 3 weeks.
Parabolic moves don't end trends. They expose timing risk. As Gary Wagner explains here, candlestick analysis is about probability, not certainty, especially after 4 straight vertical sessions. Short-term targets like 5,200 reflect momentum math, but history shows late-stage acceleration often compresses future returns. When analysts avoid timelines, it's an admission that liquidity, not fundamentals, is driving price. For investors, that's a cue to separate long-term conviction from short-term entry decisions. Chasing strength works until it doesn't. What Gary Wagner outlines next shifts the focus to silver, where risk dynamics change entirely.
I'm still going to say I feel that's less likely, but I'm going to say first quarter of this year, easily see that. And that could be with a correction in gold, because the first quarter has time to recover. But I think this is in the next month to 2 months. Long term, my target at the end of the year, drum roll, is at minimum $6,000 per ounce, at minimum. And when you hear other people coming out calling for 7,000, and these are respectable houses, they're not what we'll call the tinfoil hat analysts that were calling for 10,000 gold 10 years ago. These are strong. Who called for 7,000, David?
Let me find that for you. I don't know off the top of my head.
It was like Merrill Lynch or Goldman Sachs, or I think it was Gold. But it was a major institutional house that's highly respected, is what I'm saying. And they're calling for 7,000. I am known as a
ICBC. It was ICBC Standard Bank.
Okay. I'm looking by the end of the year to go to 6,000. And that's taking into an account that we should have a real correction.
A $6,000 gold target sounds bold, but the real signal here is who's now comfortable saying it out loud. As Gary Wagner frames it early, the shift isn't price alone. It's institutional permission, with ICBC Standard Bank floating $7,000 targets that would have been laughed off a few years ago. Historically, gold's strongest rallies often include sharp corrections of 10 to 15%, and even a pullback to $4,300 would still align with long-term bullish structure. The first quarter recovery window matters because liquidity typically improves after early year positioning resets. For investors, the risk isn't the correction. It's assuming institutional forecasts guarantee a straight line higher. What Gary Wagner hints at next reframes whether these targets are conviction or crowd psychology.
But if we look at the market historically, we have not this year, not recently. And if all things being equal, that's what I'm looking at.
Okay. All right. Gary, let's get the same analysis for silver, your upside targets for the year.
Okay. Short term again. My short-term target is about $115. I believe that we could see it dip a little bit below intraday, but I don't see a correction coming in with silver in the same way that it's possible with gold if the professionals really want to pull profits. I think that anyone initiating a short right now is willing to go in front onto a railroad track, stand in that track and watch the train heading towards them at 60 miles an hour and think they can play chicken. But markets also go down when institutional or large positions are liquidated. You have to sell to do that. And that would be more likely to me in gold and even in silver.
Silver looks unstoppable until you remember how fast leverage can unwind when institutions decide to move. Gary Wagner makes the point early that history doesn't support casual shorting here. But that doesn't mean downside risk disappears overnight. Silver has seen single-week drops of 12 to 15% during liquidation events, even inside powerful bull markets. The difference today is positioning. Silver remains thinner and more volatile than gold, making forced selling more violent when it happens. Retail investors hear no correction and assume safety, while institutions hear crowded trade. The next move Gary Wagner describes may depend less on fundamentals and more on who rushes for the exit first.
But I think that silver is such a hot commodity because for a couple reasons. Gold is pricey now. And for the average investor who wants to buy and get involved in the precious metals, they're much more comfortable looking at silver even at 100 an ounce than they are at gold at 5,000. They feel like they're getting bang for the buck. They're able to buy incrementally with actual 1 ounce, rounds, as opposed to if you get a tenth of an ounce for $400 in gold, it's like a dime. It's not that much. They want to see it. The one thing about the metals is it's something you can hold, touch, and accumulate. That's my short-term target. In terms of my end-of-year target, the way we've seen it explode, I'm looking for 160 to 180 by the end of 2026.
The biggest market to move last year was the gold market, far better than the tech markets and so on. And the U.S. markets underperformed foreign markets because of the fact you could see it in the numbers of the central banks and so on.
Silver's appeal isn't just price, it's psychology. And that's where risk quietly builds. Gary Wagner points out early that affordability pulls in retail buyers. But history shows retail-driven demand often accelerates volatility, not stability. In past cycles, silver's biggest surges were followed by drawdowns, exceeding 30%, even when long-term trends stayed intact. Central bank flows favor gold, not silver, which means silver relies more heavily on sentiment and momentum. For portfolios, that makes position sizing critical. Owning silver isn't the same as surviving silver. What Gary Wagner flags next challenges whether accessibility is actually a strength or a hidden fragility.
So let's just look at the fact that on the other side of trade deficits and trade wars are capital and capital wars. Is you look at what is happening and why it's happening and who's buying it. Let's just take a moment on that capital war issue, okay? We know that both the holders of US dollar denominated debt, which is money, and those who need it, the United States, are worried about each other, right? Mm-hmm. So if you have other countries who are holding it and they're worried about each other and we're producing a lot of it, that's a big issue, right? So you have to explain what is going on with fiat currencies, generally speaking.
By the way, he also wrote on Twitter, X, a couple months back in 2025, that he thinks that a return to a gold standard is not out of the question in the next decade or in our lifetime. So let's just comment on what you heard just now, Gary.
Well, first, that's why Ray Dalio is Ray Dalio and is the man. He's brilliant, and he picked up on something that I am interpreting a little bit differently, but it's all based on what he just said. All of us have come to a conclusion that fiat currency can't last forever and it's going to have dramatic implications. But what he talked about wasn't consumers' sentiment about fiat currency and the fact that, the buying power each year is less and less and less.
This isn't about trade wars anymore. It's about trust, and that's what's quietly breaking. Gary Wagner references this early by tying capital flows to currency confidence, echoing Ray Dalio's warning that fiat systems historically fail under debt stress. Global debt now exceeds $300 trillion, while central banks continue expanding balance sheets with no credible exit strategy. Gold benefits not because of fear headlines, but because capital seeks neutrality when currencies compete. Investors focusing only on price miss the bigger risk: currency debasement reshaping asset allocation for decades.